Hello there, Hector Davil here. In this particular video, we are going to take all we learned on the previous video as far as reading the spike, and we are going to push it one step beyond. And that's going to be an aggressive step. Alright, and the reason for that is because we are not only going to be reading the spike, but now we are going to be fading the spike. Alright, so like I say, this is gonna be a little bit of an aggressive approach, so I may understand that this technique may not be for everyone. Alright, anyway, let's get going. Okay, well, first of all, let me recap real quickly on what we saw on the previous video as far as reading the spike. Alright, like I said, fading the spike is based on the same principles, but just adding an extra touch of risk. Alright, so reading the spike was all about drawing short-term levels of support and resistance, intra-week support and resistance as per the last 2 or 3 trading days. Then we would wait for the news to come out, and once they are out, we would check the deviation and the spike in order to confirm that A, they both came in agreement, and B, we did in fact have a spike testing or retesting one of those key levels of support and resistance, right? Then we would wait 10 or 15 minutes for the news momentum to die out, to settle down, and then once those 10-15 minutes have passed by, we would compare the spike against those levels of support and resistance. Okay, we would be basically verifying whether the spike had breached through those levels of support and resistance, or whether those levels had been holding and therefore the spike gave us a sharp bounce off those levels. Alright, and then once we saw, or once we had our readings, our answer from the market behavior, we would be searching for short-term trading opportunities in the direction of those market reactions. If we got a breakout, we would trigger on the shorter time frames, as per our intraday trading system, we would trigger the first long signal in the direction of the breakout. In the other hand, if we had a bounce, we would search, or we would take the first short signal upon this bounce. Okay, that was basically what was all about. Obviously, it was short-term trading, meaning that we would be taking those entries as soon as possible and with tight or conservative profit-taking levels. Well, now let's take that aggressive step, and instead of just reading the spike, we are going to be fading the spike. As you can see, I've crossed out few different elements on the equation, okay, and I'm gonna walk you through the changes we are gonna implement. If you want to fade the spike, we still need to draw the short-term levels of support and resistance, okay, from an intra-week perspective. Then we obviously need to wait for the news to come out. And again, we need to confirm that the deviation and the spike are both in agreement, and that obviously we get some type of spike, some type of market reaction to the news. Anyway, now comes the risky part. We are not going to wait for the momentum to die out. We are not going to let those initial 10 or 15 minutes to pass by. Instead, we need the news momentum. Okay, we are gonna be trading within the spike. The main difference between reading and fading the spike is that when you are just reading the spike, you are actually just using the news announcement, and therefore the price spike in itself, as an analysis tool. Alright, you're just using the spike to analyze how strong those levels of support and resistance actually are. Alright, you are just using this spike in order to determine whether those levels hold or not, whether there is enough trading volume around those levels or not, and therefore whether price breaks through or respects those levels of support and resistance, in order to get an idea of your next trade, as per the direction of your next trade, whether it's going to be a continuation trade or a reversal trade, right? That's what you use the news spike for, just to analyze the strength of those levels of support and resistance. However, now if you trade, or if you fade the spike instead of just read the spike, You are going to be directly trading the spike in itself. You are not only going to be using the spike as an analysis tool, now you're going to be using the spike as an entry tool. And therefore, you need the spike to be alive. You need the price spike to be kicking. You cannot wait for the momentum to settle, okay, for the dust to settle. You need the spike to be moving because you are going to be trading within the spike, and therefore you need movement there in order to gauge, in order to fish some profits out of the market, right? So instead of letting those initial 10-15 minutes to pass by, you are gonna be trading within those first few minutes, okay? Now, before the momentum dies out, you are gonna compare the spike with those levels of support and resistance. Once again, you are going to be confirming whether we get a breakout or a bounce. Now the difference is that we are not interested in breakout trades. Okay, we are not going to be trading breakout trades. I will tell you why in a minute. But for the time being, please mind that we are going to be only trading reversals. That's why we are going to be fading the spike, okay? Because just picture the spike as a rocket, okay? The news come out there, price rockets off, okay, price gains acceleration within seconds, and then it bangs onto one of those key levels of support and resistance. And if the rocket runs out of petrol, if the rocket runs out of gas at that moment, we are going to be trading as the rocket falls back down. And please mind that this retracement here happens in just as much as momentum as the initial push in itself, okay? That's why you cannot wait for the momentum to die out. You are going to be needing and trading within this momentum, all right, as you fade the spike in the opposite direction, all right? And and then finally, as I was mentioning before, you are not just going to be using the spike as an analysis tool in order to determine your next or the direction of your next short-term trade. Instead, you are going to be trading the spike in itself. Okay, that's why I crossed this last line. Again, your entry is not going to be based on whatever intraday trading system you follow. Instead, you are going to be trading the spike in itself, which is exactly what we are going to be talking right now. Alright, here's how you trade the counter spike. Please remember, we are not going to be trading continuation pushes, we are just going to be trading reversals, and therefore we are going to be trading the counter spike. Okay? Alright, first of all, as already established, we need to wait for the spike to clash against a significant level of intra-week support and resistance. Alright? We need to wait for price to either touch and bounce or break and then come back down below that particular level of support and resistance. This would be effectively some sort of a fake breakout, but as you know, it's still considered as a valid bounce. All right, as long as price doesn't push above that level, then that level is still valid, is still in place, even though we may get some type of a fake breakout there. All right, so we wait for the spike to clash against a significant level of support and resistance from an intra-week point of view. So, as price touches that level, okay, as price shoots off and touches that level, we are going to go ahead, anticipate the possible bounce, and we are going to go ahead and place a sell stop order 10 pips below that level of support and resistance. Well, actually here I wrote support and resistance plus 10 pips, whereas in fact this should be support and resistance minus 10 pips. But anyway, you get the idea. All right, so as price touches that level, we go ahead and place a stop pending sell order 10 pips below that level, or if you so prefer, you can have the order ticket window with your sell button ready to be clicked on a market order, right? On an instant market order. So as price turns around, you click right away on that sell order. My advice: just place a stop sell order 10 pips below that level, so as price stands around, your broker will automatically fill you in the market. If price doesn't turn around and instead we see a breakout, okay, a full breakout, well, you know what to do. You simply go ahead and cancel that trade, okay, as simple as that. Now, please mind that this bounce here can happen within seconds, okay, within 5 seconds. So you really have got to be nimble here. You may actually want to have everything ready in place. You may want to have that sell window or that sell button ready to be, ready to be punched in as the spike is taking off. Okay, be prepared because, like I say, all these things happen within seconds. Now, it doesn't quite matter what time frame you choose in order to follow the spike. It can be the 5 minutes or the 15 minutes time frame. It's entirely up to you. Simply please remember that those levels of support and resistance, you are better off drawing them on the 1 hour time frame. Okay, that's at least is the way I do it. All right, I draw those levels on the 1 hour time frame, and then whenever the news is to be released, I follow the spike on the 5 or the 15 minutes time frame. Okay, so once the entry is in place, where do you set your stop loss? Well, your stop loss is to be set at the same level of that support and resistance level you were basing the trade off. All right. Now, wait a second here, Hector. That's a 10 pip stop loss only. I mean, since your entry is 10 pips below your that level of support and resistance, that means that that's going to be indeed a 10 pip stop loss. Yes, I know that. Yes, I know that. But please mind that this is almost scalping. All right, this is almost scalping. We are going to be scalping here, and actually, since this is a momentum filled strategy, since the spike, both the spike and the counter spike should happen in massive momentum, you should not see price wiggling here. In fact, if you see indeed price wiggling up on your entry, chances are that that's not the type of trading conditions you want to get involved here. You want to see price shooting in one direction and then shooting back down in just as quickly. You don't want price to be hesitating around entry levels, and therefore you don't need to stretch your stop loss any further. You don't need to give that trade any more breathing room. That's just 10 pips. Again, because chances are that if this is to be a successful trade, up on your entry, price is going to simply shoot off away or reject away from that level of support and resistance. So 10 pips, more than enough. You don't need to stretch your stop loss any farther away. And what about the targets? For this strategy, we are going to use a dual exit strategy, meaning we're going to exit the trade in 2 different profit-taking levels. First one is to be located 10 pips plus the spread away from your entry point. So if, for example, we are trading the sterling pound against the American dollar, which is a currency pair that usually carries a 2 or 3 pip spread depending on your broker, well, that means that you will set your first target at 12 or 13 pips from your entry point. Okay? And you are not going to trail your stop loss to break even. You are going to leave your stop loss where it is. Okay? The idea here is that as your first target is hit, which usually should happen very quickly, again, this is a momentum move, and 10 pips is nothing in the market around news announcements. Okay, 10 pips fly by in like 1 second. All right, so you're going to exit your first portion of the trade, which, by the way, is going to be 50% of the trade at 10 pips plus the spread. The idea here is to offset the risk of this trade as soon as possible. Please mind that this is a high risk strategy. All right, so the idea here is that upon our entry, the bounce has still momentum enough to push price another 10, 12, 13 pips away from your entry. You cash out 50% of the trade, and therefore you've made money on this much of the move, and you are still risking this much on this trade, since you are not trailing the stop loss to break even. So once the trade hits your first target, even if it turns around and hits your original stop loss, well, you've made money again on 50% of the position here, and then you will lose 50% of the trade on this counter move up here, and therefore all in all is going to be a scratch trade. The point of this first target, exiting 50% of the trade at entry plus the spread, is to completely offset the risk on the trade as soon as possible. This is a very common strategy of mine whenever I am trading high risk strategies. I like to offset the risk of my trade as soon as possible, and therefore, since I don't really have enough breathing room to trail my stop loss to break even, what I do is I simply exit half of the trade very early into the trade. Okay, this is just 10, 12 pips if we take the spread into consideration. Again, this is just nothing. It's just 10 pips. Price should trigger your first target within 5 seconds, and once that happens, the risk is completely gone. All right, so that's the idea here, to offset the risk as soon as possible. And well, what about the second target? Where do we exit the remaining 50% of the trade? Well, we are going to set that second and final target at the beginning of the spike. If the news came out when price was trading at that level, that's obviously the beginning of the spike. All right, so that's where you are going to exit the second portion of the trade, the second 50% on this trade, because in my experience, whenever the technicals overwhelm the spike, it's rather common to see market action canceling the spike altogether, meaning that if the spike shot up for, 30, 40 pips, the market usually tends to retrace those 30 or 40 pips rather quickly, at least all the way to the beginning of the spike, okay, or to where price was trading at as the news hit the market. Okay, so like I say, around there is where you want to exit that second portion of the trade. If you took your trade with 4 lots, you will exit 2 lots there for plus 10 pips. Okay, plus 10 pips plus the spread again. Then you will exit the remaining 2 lots at the end of the spike, or rather, sorry, at the beginning of the spike, and at no point you will trail your stop loss to break even. You will just leave it there, okay, at that level of support and resistance, which effectively will be also 10 pips. Okay. At the beginning of this video, I was mentioning that you don't want to trade continuation spikes. You only want to trade counter spikes. Okay, remember that? Well, there are a few reasons for that. First of all, we would have a hard time setting our exact entry level. Let's assume we follow the same approach as when we tried counter spikes. We set the entry 10 pips above or beyond that level of support and resistance. All right, 10 pips beyond breakout point. However, if we do that, chances are that we'll get triggered on a number of fake breakouts. As I've mentioned over and over throughout the last few videos, you cannot expect those levels of support and resistance to be respected right to the pip when we are trading in high volatile market conditions, because price moves too fast and therefore we cannot really get sharp bounces again right off to the pip. Sometimes it happens, but like I say, expecting price to always respect those levels of support and resistance rather accurately is probably asking too much. So fake breakouts do happen, and they do happen often. So if you set your entry 10 pips beyond the level of support and resistance, you will be triggered on many of those counter spikes, okay, fake breakouts, and therefore your stop loss is going to be hit rather often. All right, obviously that's certainly not what you want, and despite the fact that this is a high risk strategy, we still want to somewhat control down on the risk factor, and like I said, I've never been able to control my risk. Trading continuation spikes is just too much or too chaotic, too random for me. My entry has been triggered hundreds of times on those fake breakouts, and therefore I just don't do it anymore. Okay, I've decided to, again, even though this is a risk or high risk strategy, still I need to somewhat control my risk, and the only way to do that is to avoid trading continuation and stick to what works best, which is again reversal spikes or counter spikes. Now, the second reason as of why I don't like trading continuations is because I don't really know where to locate my final target. I don't have a level of reference. When I trade counter spikes, I do have one reference level in order to locate that second target, which is the beginning of the spike. All right, the price at which that currency pair was trading as the news announcements hit the market. In the other hand, I don't really have that level of reference in the other side of the fence, meaning continuation breakouts. Should I maybe add this entire distance to the upside? And if so, why should I do that? What's the market logic, the market reasoning behind doing that? I see no particular reason for doing that. Okay, so I would simply be randomly locating my second target for no particular reason. Okay, and I personally don't like to do that. I like to set my profit taking levels for one specific reason. Okay, and when I trade counter spikes, the reasons of why locating my second target, my final target at the beginning of the spike, is because in my experience the market tends to cancel out altogether that spike by retracing all the way back to where it all began. That's my reasoning in order to that's my reasoning behind locating my second target there. However, I just don't have that, or at least I haven't gained that knowledge when I trade, or when I used to trade continuation breakouts. Okay, so again, multiple reasons as of why I don't like trading continuations, and therefore, again, my advice: please stick to reversal counter spikes. Okay. Alright, well, that's all as far as fading the spike goes. Let's wrap it up real quickly. First of all, you will need to draw your intra-week levels of support and resistance, and then obviously wait for a news to come out. Then you'll have to check whether we do indeed get a deviation and therefore a spike, and if we get a spike, you are not to wait for the momentum to die out. Instead, you are to compare that spike with those levels of support and resistance you previously marked. If we get a breakout, well, you cancel that trading opportunity. In the other hand, if you get a bounce, you are not just going to be using that bounce or that market reaction in order to determine the direction of your next trade. Instead, you are to, in fact, jump into the counter spike as the counter spike is developing, okay? As per the levels we've previously explained. You may want to pause this video and to write this down on a piece of paper in order to have it ready for you to use on your next news announcement, okay? Alright folks, that's all about fading the spike. I hope you've enjoyed this video. I'll be waiting for you at the next one. Cheers, bye-bye.